Good morning from our global headquarters in New York. I'm Manus Graney. You're welcome to Bloomberg Brief. Let's set your agenda. Health check in the USA as the bond bulls retreat. Non-farm payrolls expected to add 150,000 jobs. Tensions rise in the Middle East, weighing on stocks as crude tracks for the biggest weekly gain since early 2023. And reopen the ports. Dock workers called time on the strike, delivering a 62% pay deal. A little bit of breaking news for you now coming through from the EU. We will come back to that in just a moment. There are tariffs coming down the pike on electric vehicles for China. Right now, this is where we are. We're steadying our nerves. We're on track for the first weekly loss in over 4 weeks. Let's just give you that breaking news. This is what we've got. The EU votes to impose tariffs of up to 45% on China-made electric vehicles. Of course, the risk here is retaliatory action from the Chinese. The vote comes as the European Commission determined that China unfairly subsidized their electric vehicle industry, and they proposed the tariffs to protect the European car companies. We'll have more on that story through the morning. Let me just show you what is going on in the markets. As I say, a little bit nervous. One could say that the bulls are nervous both in the stock market and indeed in the bond market. The whisper number at the moment is 152,000. Bank of America say if you get anywhere between 125 and 175, it is a soft landing. Roll it over, have a look at the bond market. We've backed up this week on the 10s, up 6 basis points yesterday. Services numbers here in the United States of America, the fastest pace of growth since 2023. Yields tick down ever so slightly. Going into this jobs report, by the way, you are the least bullish on this market, according to BMO, since January 2025. And just the backdrop to this 24 hours is services are strong. You are looking at the last 2 jobs reports. We saw equities drop by over 1.7%. So brace, brace, brace. Let's see what happens today. Economists are anticipating it's been described as a stable growth for today's jobs report. 8:30 a.m. Eastern. We'll bring you all the details on surveillance. Geoff Yu is my guest this morning, Senior Strategist for EMEA Markets at BNY Mellon. Geoff, good morning to you. We're looking at a progressive slowdown in the United States in the jobs market. So it's not a Wile E. Coyote moment. It's not some precipitous drop. That's the base case thinking. What does that mean for the landing?
Yeah. Well, you say that's the base case thinking, but given all of the jobs reports here from Jolt to ADP, maybe not the Challenger survey, but I guess, there are those in the market to think about a tail risk of not exactly re-acceleration, but what if we just don't, quote unquote, land further from here, right? So I think, that's sort of just a short-term tactical element we need to think about. But the bottom line is for those exigent positions looking for another 50 from the Fed or anything like that, I think they need to just re-explore them very, very carefully. That's looking like a long shot right now.
Well, this comes back to the concept. Adam Posen was with us yesterday. He said just because you take out an insurance policy like a jumbo rate cut of 50 basis points, do not assume that they will buy that again. And that's where you come down, is it?
Absolutely. And if you think about, what the Fed's been trying to communicate, there's no sense of panic. Even with the 50 itself, it was a bit of what I would call a down payment for insurance, not even outright insurance. So, just making sure that they tell the market they've got, their hands, at the steering wheel, making sure they know what is going on. But it's going to be data dependency at the end of the day, whereby if we look at what's going on in Europe and the ECB, they're looking at the risk of current data outturns deviating from their baseline forecast to the downside, hence a bit of a change in tune of late, and whereby the Fed doesn't really need to do anything at this point. It's a bit like autopiloting.
Well, if we're autopiloting at the moment, the risk is that the tail risk fattens up, and that is the unemployment rate. Given historical data and trends, but looking at the current state of this U.S. economy, it doesn't seem that unemployment rate is in danger zone anytime soon.
I don't think so, and that would be conducive to the Fed's outlook. And of course, they will say if we get a sudden surge and things along those lines, then they will be in a position to change their minds. I think communication has been very, very consistent, right? So we can head into November and the December decisions and see if there are any revisions to that. Of course, I think the market does have one eye on the current surprises in both directions to the data, but also with other things in geopolitics as well.
Tell me this then, Geoff. on the dollar, if you have a soft landing, no landing is where you are. Does that underpin U.S. exceptionalism and then quid pro quo with the dollar?
It does, and to be frank, even with the Fed's communication in September, I think US exceptionalism was in place. It's just a question of, from a scale of 1 to 10, your overweight in the US, you were probably at 13, and now you can bring it down to 9, right, so to speak. All right, and that, in hindsight, is where, looking at my euro-dollar core for the year, I just underestimated the degree of US exceptionalism positions, which are on the potential for them to be unwound. But now at this point, you look at dollar-yen. I think with the exception of dollar EN APAC, right now, people are still happy owning dollars. Slight increase in the carry trade again, but it doesn't mean the dollar can't be on the right side of that either.
Indeed, and geopolitics also adds into the baseline for holding dollars, perhaps relative to the others. I want to get to the port workers. They've called off the strike. They have a 62% pay rise over 6 years. I look at Boeing, they're putting 30% on the table. How do you look at the wage narrative, the negotiating wage cycle going forward from here? Does this create stickier inflation, wage inflation?
Yes, and I think all central banks are communicating that right now. Equilibrium rates, neutral rates, and also long-term unemployment rates, that could actually be lower than expectations. And this is something really, really difficult for central banks to calibrate when it comes to supply issues and labour supply issues. So they have to look at this very, very carefully, and especially with the ports, right, that had the potential to have knock-on effects into other areas of the economy as well. But look at the UK, public sector, wage increases. Is that going to be a focus for the upcoming budget as well? And I think this would underpin the comments we've just had from Hugh Pill, just saying, hold on a second, let's not be too hasty and cutting very aggressively. You don't know where the wage outlook right now is.
Well, there's a classic between Bailey and Hugh Pill, isn't it? I mean, mind the gap and the damage that you do to sterling. Always good to get your view on what's happening in Japan. Lots of headlines. The carry trade's reignited. Ishiba, he's knocked the yen off by 3% this week. The economy isn't ready for further interest rate hikes and then sort of backtracks. This is interventionism in a different way.
Indeed, and I feel like we're just getting a few too many headlines, from Japan and not from the BOJ, if you know what I mean. So, that's one aspect to look at. But I think with the yen carry trade, notwithstanding that episode we had in August, when there was a lot of unwinding, cleared out a lot of the positions. If it ain't broke, don't fix it. But if I look at our custodial data right now, tracking the flows, what's interesting is the yen is still underheld. So let's be clear, people are owning the yen-funded carry trade, but not so much as dollars. It's actually the likes of long EM currencies against the yen, Mexican peso, for example, Brazilian real, those positions, euro yen, Aussie yen even, I think that is actually forming the crux of the yen carry trade right now, and they may just suffer a bit of a wobble on the other side. But dollar yen right now, it just feels like people are comfortable, owning it as long as they want to hold on to that US exceptionalism, especially for the next 2 or 3 weeks or so.
Well, look, it is pervasive, isn't it, with geopolitics and, of course, an election which is upcoming 30 days out. Geoff, thank you so much. Geoff Yu from BNY Mellon. Other stories trending on your Bloomberg terminal this Friday morning. Spirit Airlines is struggling to reach a rescue deal with its bondholders, and the time is running short. The air carrier is seeking new financing from its creditors and an extension to the current debt, or it risks being forced into bankruptcy. That's according to Bloomberg sources. Cisco has agreed to invest in one of the hottest young companies in AI. CoreWeave is a client computing provider that got the edge in the market by adopting NVIDIA GPUs in its data centers. The startup is close to reaching a deal with Cisco, which could value the company at $23 billion. Seven & I has approached potential buyers for multiple businesses within the supermarket empire. The Japanese retailer is looking to restructure as it faces a takeover approach from Canada's Couche-Tard. The 7-Eleven owner faces pressure to show it can command a higher valuation and rejects a preliminary approach for being insufficient. Well, coming up, the US dock workers, they head back to the ports as the talks continue. What is on the slate?
The dock workers are going back to work, and the next 90 days we're going to settle everything.
And later this hour, we'll count you down to the payrolls report. City's Veronica Clark joins me around the desk with Mike McKee. Economics is first on Bloomberg.
the strike is over.
Yes, the strike's over. We got a call from our international. We're going to receive a 61.5% increase over the next 6 years, and we're going to have other language to protect us from automation worked out over the next few months and other issues that we need resolved.
That was the ILA Local 333 President Scott Cowan speaking as soon as the US dock workers agreed to suspend the 3-day strike. Now, the union and the employers will restart negotiations on the longer-term contract. What exactly does that mean? Brendan Murray is with me. Brendan, this was resolved pretty darn quickly, but when I look at the language from the ILA President Daggett, he says, we want absolute airtight language, no automation or semi-automation. So there's a wide gap here between the pay deal and real resolution.
Yeah, absolutely. I mean, I think we can chalk this up as a small win for three different stakeholders here. The dock workers get their pay increase, 61.5%. You heard one of them say the shipping lines get to resume, global trade, exports and imports without a ton of disruption. And the White House gets a reprieve from an economic situation that was quickly going downhill. Another week or so, and we would have seen shortages of food and other kinds of things on grocery shelves, and that could have set off, some panic buying. So all three basically walk away with a little more time to work this out. Definitely the key issue of automation is one that they've been talking about for years, let alone the past couple months during these contract talks. So automation is not an easy situation. The shipping lines, the port operators want to make their operations more efficient. The dock workers say that's our livelihood. We're going to stand firm on that. So definitely a win for several parties, but still some tough talks ahead.
Look, this is going to be political relief for the White House, obviously Biden known as Union Joe. But for Harris, this is also critically important because she's slightly behind relative to her other former peers when it comes to support from the union. So this is a sigh of relief for her, isn't it?
Oh, definitely. I mean, I think there's a sense that this situation, if it lasted much longer, could really cause a problem. That the incumbent, White House, Joe Biden and by association, Kamala Harris, couldn't find a resolution, couldn't deal with this situation in a way that prevented the shock to the economy, the shock to consumers. So definitely, a sigh of relief this morning. The ports are reopening. That may take 12 hours, 24 hours. A lot of them are going to be open this weekend to deal with the backlog. So, there's 40 ships out there. That will take about a week to work through.
Brendan, thank you so much. Bloomberg's Brendan Murray on the port strike coming to a close. In the Middle East, the Iranian Supreme Leader speaking earlier at prayers in Tehran saying, quote, "We will strike again if necessary." Now, this as the attacks in the region continue, with Israel bombing more than a dozen Hezbollah targets in Beirut. Hezbollah also claiming that it fired rockets at Israeli army positions. Meanwhile, the G7, the nations there, releasing a statement calling for restraint, writing, quote, "A dangerous cycle of attacks and retaliation risks, fueling uncontrollable escalation in the Middle East, which is in no one's interest." Paul Wallace is with me now. Paul, when you read that story from the G7, we are incrementally every day getting closer to some kind of break point, and that is the worst case scenario, which is hitting Iran in some of these strategic positions on oil or indeed their nuclear facilities. But oil is squarely in focus this week.
Hi, Manus. It definitely is, especially after Joe Biden's comments yesterday when he said that there were discussions around Israel hitting Iranian oil facilities, which immediately sent Brent crude soaring. So oil is certainly in focus. It's unclear whether Israel has actually decided what it wants to do, and it's just waiting for what it feels is the best moment. There's a lot of feeling that it would react quite quickly within a matter of days to Tuesday's missile barrage from Iran. So there's certainly a strong feeling that we could get something, the answer to what Israel will do, over this weekend.
Here's the thing, Paul. We're up 8% on the week. Lots of analyst notes coming out about the potential impact of taking out Iranian export facilities, which is just under 2 million barrels. We're juxtaposed between the surplus and the potential loss from Iran. How do people look at this market? It's tightening up, isn't it?
It is tightening up. And I think for some people, if, let's say, and this would, I think, be an extreme scenario, but let's just say Iran's exports were completely taken off the market. The global oil market could probably cope with that. Other members of OPEC have enough spare capacity and then some to sort of make up for all Iran's exports coming off the global market. But you've got to factor in what Iran's reaction will be in that situation. And Iran has been implying that it will retaliate very aggressively against any kind of strike on its territory, not just against Israel, but against any country it thinks is aiding Israel with those strikes. And in that situation, if Israel does go after, its oil export facilities, I don't think you can say that, Saudi facilities, UAE facilities, and those of other countries in the Gulf are completely off the cards. They may not be, and I think this is what the G7 is implying when it talks about, a spiral, an uncontrolled spiral in regional tensions. We get these tit-for-tat attacks, but they're pretty major ones. And
would
each
a spiral,
one of them gets
Paul,
worse.
if we're to consider what a spiral out of control looks like, it squarely comes to the geography near where to you're sitting, which is the Strait of Hormuz. And of course, it's been a long time since the Houthis attacked infrastructure in Saudi Arabia. We're a long way away from what that was a number of years ago. But that's squarely what we're talking about here, which is heightened risk in the Strait of Hormuz.
Exactly. That is militarily, that's pretty much the easiest thing for Iran to do if things get that bad. It's much easier for Iran to hit out at tankers and facilities in the UAE and Saudi Arabia and elsewhere in the Gulf than it is to hit Israel. Israel is very far away. Israel has got very sophisticated air defenses and all that. It's much easier. And Iran could say, well, if we get into a situation where, Israel is hitting our oil facilities or our nuclear facilities or whatever, they may say, well, then we will attack other countries' assets because that's leverage we can use to put pressure on Israel to back down. And that's the kind of scenario that I think really worries world powers.
Indeed. Paul, thank you very much. Paul Wallace with the very latest from the Middle East. As we've been saying, oil is tracking higher, 5% higher yesterday on that language from Joe Biden. The U.S. is discussing Israel attacks on oil facilities. That infected a massive spike in the price of oil, up 5% on the day, 8% on the week. This is Brent this morning, adding another 1%. We are talking about the risk of Israel striking Iranian oil facilities. ANZ say that is the least likely because of the ferocity of the response. Gold is up again this morning ahead of this jobs report. It is jobs day in the USA. Of course, we've just come off a record high in late September. Coming up in the show, we'll look at what else is moving the headlines around the world, including the former president's plans to blitz the campaign trail right here on Bloomberg.
Early mail-in voting is underway now in Michigan, so if you want, go out and get that ballot, return it as soon as possible. And if not, get a ballot, just go and vote. You got to vote. We got to win this election.
Get out and vote. That was the former President Donald Trump telling his voters in Michigan, begin to get out the vote. Look at the front pages from around the world. And a picture of the campaign trail for this weekend for you. First up, Reuters. Musk will attend the Trump rally in Pennsylvania. That was the site, of course, of the assassination. The former president returns to Butler on Saturday, and it's a bit to recapture momentum, some are saying, 31 days before the election. Washington Post leads with Liz Cheney rallying with Harris, imploring the nation to reject depraved cruelty. Trump, the former Republican Congresswoman, joined the Democratic nominee in Ripon, Wisconsin, which is also known as the birthplace of the GOP. The vice president heads to Flint in Michigan for a rally later today. So they were both hunkering down in Michigan yesterday. And Bloomberg goes with Obama launching a 4-week campaign blitz on behalf of Harris. The former president will spend the run in trying to sway the swing voters to vote for his Democratic successor. A little bit of breaking news coming through for you from Israel. They're conducting limited, localized raids in the south of Lebanon. Israel says they are eliminating Hezbollah militants at close range. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Manus Cranny. Let's set your agenda. It's health check day for the USA as the bond bulls retreat. Non-farm payrolls are expected to add 150,000 jobs. Tensions rise in the Middle East, weighing on stocks. This as crude tracks its biggest weekly gain since early 2023. And reopen the ports. Dock workers called time on the strike, delivering a 62% pay deal. We're a little bit nervous. We're counting down to non-farm payrolls. 150,000 is the number that we are expecting. The whisper number is a little bit higher, 152,000. Stocks are steadying their nerves. You've got services in this country at a 19-month high, but brace for a bit of volatility. The last two jobs reports saw stocks drop by 1.7%. If you get 125 to 175, Bank of America says you've got a soft landing. A blowout report, well, that could spark a little bit of a sell-off and a jump in yields. Roll it over, have a look at those bond markets, because I can tell you what, the bond bulls are in retreat pretty much on the back of the services number, the oil spike. BMO have done their survey. 34% see the next 15 basis points as the next 15 basis points is lower. That's quite small. It's the least bullish since January 2025. We've had these yields back up through the week. We are 3 hours away from the latest jobs report. Mike McKee joins me around the desk. Mike, good to see you. Look, 150,000, 152 on the whisper, but it's the overall trajectory. It's about a progressive slowing. That's the consensus at the moment on the jobs report?
That's the overall concern. Are we slowing too fast? The economy has been producing jobs at a very, very high pace for a long time. We've started to see a slowdown now, and that has started to get people concerned about, did the Fed get behind the curve? And so we're seeing a lot of people who are coming in low. We've got 70,000 for the low forecast for the month, but we've still got a lot of people who can't get over the fact that the economy keeps surprising us, and I think the high forecast is for 220,000 right now. But as you mentioned, we have seen a slowing in the pace of job creation over the last 12 to 6 to 3 months. Mm-hmm. Each time has gotten slower. And so the question is, does that trend continue or does it level off? And that's what people are going to be looking at. Now, the real number, though, that Wall Street's going to be looking at is the unemployment rate, yes, which is forecast to stay at 4.2%, because that's the number that the Fed has emphasized. And the Fed says we're going to get to 4.4% by the end of the year. Are we?
Well, the question
Tune in at 8:30.
Yeah, I mean, look, the unemployment rate is the one that Powell has very squarely put his money down on. What you're hearing is that a low estimate of 4.4% for the end of the year? Because we've shifted by over 1% in the past 12 months, haven't we?
Well, the Fed has actually moved up to 4.4%.
Incrementally, yes.
They've been up and down as the year has gone on because it's been a very hard year to forecast. But now they're at 4.4%, which is what would tell you that if we got to 4.4%, maybe over a couple of months, then they're going to stick with the 25 basis point cut pace that they're doing. If we get to there in one jump, or if it continues then to go above that, then we might see them speed things up.
It was interesting on the ADP numbers, yes. I mean, the tagline on this jobs report is expected to be, slow of hiring, but no major firing. But the ADP was a stronger number, but it didn't come with hotter wages.
No, that has slowed, and that's helped the Fed out a lot. You've heard Jay Powell say that they don't think that the labor market and wages are going to cause inflation anymore. Now, you have some people who are still worried about that, Mickey Bowman, for one, the Fed governor. But at this point, they're not really looking at the inflation component of this, which is why at the top I didn't mention the average hourly earnings, which are supposed to tick down just a little bit.
So you're off to speak to Mr. Goolsbee. What's going to, you'll have the data at that stage. So thematically, he says rates need to fall a lot. So what's your top thought for him?
Well, we'll see what the numbers show, and does that ratify his belief, his call, or does he have to rethink it? And what would cause him to rethink it at this point? And
recalibrate, Mike. Recalibrate.
Recalibrate, yes. We have to use the proper word. I don't know. Transitory was a better word than recalibrate. It was easier to say.
Transitory over recalibration. There you go. Mike McKee. We'll break the numbers down, of course, and you can catch Mike's interview with the Chicago Fed President, Austin Goolsbee. That's at 10 a.m. Post the jobs numbers. We'll break the jobs numbers down for you in surveillance. The whole team will be there. Well, the Wells Fargo Chief Economist, Jay Bryson, weighs in on what a softer jobs print would mean for the Fed.
A year ago, all the weight was on CPI. Nobody really cared much about the labor market. We've transitioned, and, as we just said, the Jackson Hole speech, Powell was saying, we don't welcome any further weakening in the labor market. So if you do get a weak print on non-farm payrolls, if you do get the unemployment rate ticking up, another 50 basis point rate cut in November is definitely in play.
Veronica Clark is the US Economist for Citi. If you want a weakening in the jobs market, this is the lady to give it to you. Veronica, you're in at 70,000 for non-farm payrolls. Just run me through your thinking on why we touched that level, because that's low end of consensus.
It is the low. I think if we look at the whole of this year, all the labor market data that we've seen this year, there was this clearer trend in slowing even at the beginning of the year, hiring pulling back, of course, well summarized by the unemployment rate increasing. But back, 4 or 5 months ago, payrolls were very consistently strong. They looked like the outlier in a sense. But we have had a slowing now in the last 3 or 4 months. And it feels to me like payrolls is just joining the rest of the data and showing this weakening trend. And I think that trend will continue this morning. If it's not today, it's within the next couple months. It just feels like a labor market that's weakening.
So sub 100 or even at 70, which is where your call is, I mean, that is going to light a torch under the rates market in terms of calling for another 50 basis points, which a lot of people have said was an expensive insurance cut.
Yeah, I think it would be surprising if we saw 70K today. Of course, we also have the unemployment rate rising, and that does maybe matter a bit more for the Fed, have that going back to 4.3. And yeah, I think this is a Fed that is cutting 50 basis points again in November. In a sense, yes, the 50 basis points September was making up for some lost time, but every Fed official is going to think that they're very far from where the neutral rate is at this point. And you don't want to be at neutral a year from now. You want to be there as soon as you can.
And it's the single, I think to quote Powell, it's the single most important one probably. This committee is not in a hurry. So you say the data will force his hand to move him from a light jog to a faster run.
Essentially, yeah. I mean, if you listen to Fed speak about how they're talking about their forecasts over the last 6 months or so, we got this sense, of course, in June when we had that SEP update in June. They are really, not necessarily forecasting where we think the data are going. And yes, if the data evolve in line with their soft landing kind of forecast, they'll go slower. But I think we're always basing our forecast on the data first and how the Fed will react to that data.
I mean, we had Geoff Yu. He's in the no landing camp. You've got Larry Fink in the no landing camp. You've got Mark Rowan this week talking about an expensive insurance cut. You're a little bit more bearish.
Yeah, it comes down to the labor market. I mean, we definitely have had some strong activity data. Spending, we had some of those big GDP revisions higher. So the activity side of things is holding up. But I would think that if people are starting to lose their jobs, the unemployment rate is rising more sharply. That's what's going to matter more for future spending. People would cut back on spending in that case. So I do think it really just comes down to the labor market.
When we look at this political campaign, there's different promises on tax from various sides. You've got Trump, obviously, on corporate tax cuts and giveaways. You've got Harris wanting to raise the corporation tax. But when you look at the policies on debt to GDP, that's expected to rise a little bit more dramatically under Trump, up at 116 versus Harris. From a fiscal point of view, going into 2025, how expansionary will 2025 be, regardless of who comes in?
Yeah, so for 2025, I mean, most of the policies that we would expect from the election really aren't going to impact things until maybe 2026. We're not going to get,
Do we get the juice in 2026, the foundation in 25, the juice in 26?
Yeah, you wouldn't really see most of these policies implemented impacting the economy, I think, until 2026. So for 2025, deficits are still wide. I do think that's a a reasonable conclusion, regardless of the election outcome, that deficits do stay pretty wide. But we've actually had, we're coming off of a year or two of pretty substantial fiscal spending, and deficits are still wide for this year, but they're essentially flat. That growth impulse has maybe already happened. But yes, deficits staying wide, I think, is a reasonable conclusion.
Yeah, just the corollary to the conversation that we've had is that the 4.4% assumption by the Federal Reserve in terms of the unemployment rate, is that low?
I think that's a little low,
Okay.
just in the sense that, in past labor market cycles, and the unemployment rate really does look like it, now that it does in past cycles, it rises very gradually, and then you start to see that acceleration, and I think we've seen that over the summer. And at some point, you reach this nonlinearity, and it can rise much faster. That's essentially the pattern that we're thinking plays out this time also.
So you're not a buyer of this stickier, higher inflation U-turn from the Fed next year?
I can see inflation concerns coming back for sure, maybe within the next couple years. But it does seem like in a weakening labor market, demand is going to be soft enough, and consumers are already pushing back on spending on higher prices. I do think you'll get that slowing in inflation.
The consumer is all important here. I looked at some of the data from Ed Yardeni put out the revisions. Personal income revised to 3.3%, a massive upward revision there. Personal saving, $1.1 trillion, way over what we had earlier in the year. So all the call about the demise of the consumer is perhaps a little bit overdone. I know it's bifurcated, and I know a lot of this income comes from land, it comes from rent, it comes from perhaps middle class and upper middle class things. But this economy and this consumer remains resilient.
Yeah, those big upward income revisions were a bit surprising, essentially because they're also based on that QCW data, which is telling us that employment was even less than we thought. So those were a bit surprising. It does seem like the consumer is coming from a bit healthier place, but what's going to determine marginal spending is, I think, if you have a job going forward. The biggest component of income still is labor income, and if payrolls are slowing, that will be slowing, and I think people would be cutting back on spending then.
And the refinancing in mortgages, I mean, we're seeing 30-year mortgages dip. That's healthy, that's progressive for the housing market. Does that just tinker at the edges, really?
Yeah, we've seen, we have more weekly data on mortgage refinances, mortgage applications for purchases. Those refinances have come up a little bit, but most people are going to have a mortgage rate that's still much lower than where we are now.
I'm not getting you anywhere off the slightly bearish peg. Veronica, thank you so much for being with us this morning. We'll see what those payrolls numbers are a little bit later on at 8:30 a.m. The surveillance team will break those down in detail for you. Veronica Clark, our guest this morning from Citi. Coming up, the analysis, a little bit more for you. And this time, we're going to talk about Kamala Harris and Donald Trump and their plans for the economy. Context matters on Bloomberg.
The strike is over.
Yes, the strike's over. We got a call from our international. We're going to receive a 61.5% increase over the next 6 years, and we're going to have other language to protect us from automation worked out over the next few months and other issues that we need resolved.
That was the ILA Local 333 President Scott Cowan speaking as soon as the U.S. dock workers agreed to suspend the 3-day strike. The union and the employers will restart negotiations on longer-term agreements. Brendan Murray has been tracking this story for us. Brendan, this resolved quite quickly. The question is, of course, this is the start of a much bigger renegotiation around automation, and the unions sound pretty aggressive about no jobs lost on automation. That's a hope rather than a probability.
Yeah, exactly. So the dock workers are going back to work today. The ships are going to start moving, and the White House is waking up with one less economic problem on its hands. The union got what they wanted in terms of wage increases in this new 6-year contract, a almost 62% increase in total over that span. But the automation issue is one that they're going to have to really dig in their heels on, because ports all over the world are automating, and if the American longshoremen are going to hold back the tide of that, they're going to have a lot of work to do over the next 3.5 months.
Okay, Brendan, thank you very much. Will the docks reopen? The bananas will come for sure onto the eastern seaboard. There was a lot of concern over that. Brendan Murray tracking the dock workers' strike. It has been suspended, and the US is still facing industrial action from the plane maker and the risk of losing jobs in the steel industry. But the future of its labour market depends on the presidential election, and that is 32 days away. Enda Karen joins us for our election brief. He covers the US and global economy and joins us to analyse what the candidates are proposing. Look, today's jobs report, let's just square this away. There's a political potency to the next two jobs reports, Enda, isn't there? And for one thing, the port strike has been removed, and so they will be cleaner reports than perhaps we'd anticipated.
Yeah, it feels like we're at something of a turning point in the jobs market, Manus. Clearly, demand for labour is weaker. That's coming at a critical time just ahead of the elections. The manufacturing sector, for example, they're cutting jobs, and that resonates in the swing states. So obviously, a weak jobs number today will be fuel for the Trump campaign that the Biden-Harris administration aren't running the economy very well. Likewise, a good number would allow Vice President Harris to say they're pulling off a soft landing. So there is a lot of political capital coming out of the jobs data today.
Well, let's just dig a little bit more into Trump versus Harris. If we look at the Trump campaign, it's very much about lower taxes, the use of tariffs. You're looking at a corporation tax of around 15%, Harris at 28%. One is about intervention. One could say Harris is a little bit more interventionist relative to Trump. But I'm drawn to what Maya McGuinness says. This is an Oprah tax environment. You get a tax, you get a tax break, you get a tax break. Let's start with Trump first of all, because the tax breaks he's talking about has significant impact on the debt to GDP and on the fiscal aspect for the US.
Yeah, no doubt, two very different economic visions being offered to the public. Very large gulf in the policy proposals. Like you mentioned, on the one side, former President Trump wants to bring down taxes writ large, bring down the corporate tax all the way to 15%. And, of course, raise tariffs on goods coming into the country. Now, he says that will generate investment, it will drive innovation, and it will prod more manufacturing to be based in the US. And more manufacturing based in the US means more jobs. So, again, that's a message to those swing states. But, of course, the pushback, like you mentioned there, Manus, is economists say, hold on, there could be some inflationary aspects to that. And, of course, they're questioning what would it mean for the fiscal deficit. Of course, it would mean that deficit continues to blow out. That's the cautionary side of the Trump proposal. But yes, quite different from what Harris is talking about.
Yeah, I mean, and we were talking about this. This is a debt to GDP ratio of 116% by 2028 under him, 109% under Harris. So the question then becomes under Harris. I mean, the accusation is from his camp is that this is an interventionist potential president. She wants to do tax deductions, but she wants to do tax deductions on childcare, on medical care, and of course on small businesses. So to that extent, and how much of an impact on the deficit would she have relative to Trump and to growth?
So both are, neither candidate are preaching fiscal austerity, Manus, to be clear on that. But I think when it comes down to who would drive the deficit out the largest, the biggest gap still comes on former President Trump's side. As you mentioned, Vice President Harris is talking about raising the corporate tax rate. She says that will offset some of the revenue losses around her proposals around the childcare tax credit and tax breaks for small businesses. But the bigger fiscal hole is still on the Trump side of things. Economists have pointed this out. In particular, they question whether or not the projections for revenue to be raised by tariffs will be enough to fund the policies that he's talking about. And again, this just speaks to the idea of where there is a gulf between both candidates and a very different economic vision. Like I say, neither preaching fiscal austerity, but the bigger gap in terms of spending and revenue probably seen on the Trump side more than the Harris side.
Look, before we just touch on the immigration policy from Trump relative to Harris, on the tariffs, the risk is 20% tariffs on all imports. This is what has been touted, and 60% on China. There's a retaliatory risk on that, and that can be an inflation and a growth negative, can't it?
Exactly right, Manus. And again, economists will say, OK, on paper, those policies might stoke growth, they might stoke revenue and spur manufacturing to be set up here, but the trade-off and the cost is that it could also result in a higher cost of goods for consumers. And there are question marks over what revenue would ultimately come from tariffs. Anyway, revenue from tariffs tend to peak at the very beginning, and then it starts to decline because consumers change their spending patterns, manufacturing and production supply chains shuffle around. So there are a lot of variables at play when it comes to using tariffs as a principal source of revenue for these policies.
Let's just square off on immigration, because the Trump campaign and the policy has been about the biggest deportation on record. And then you look back at the security bill, the border security bill, which was thwarted a couple of times in the run-up to this election. How do you think, if he does get into power, the biggest deportation on record would be affected? How would it actually work, Enda?
So one of the most sensitive areas of the campaign has certainly been immigration. And as you mentioned, Manus, former President Trump probably has the starkest approach. He wants to push through, if elected, this mass deportation campaign. And the mechanics of that are not clear. A lot of companies and businesses will tell you that they have relied on the immigration surge over the past couple of years to fill positions that they otherwise could not have filled. Policymakers will say immigration played a role, of course, not just in ensuring the economy pulled off a soft landing, but in offsetting inflation. So if you were to bring a mass deportation campaign into the middle of that, lots of people are asking the questions around what are the mechanics of that? How does it work? How do companies go about declaring whether or not they have legal or illegal immigrants, the practicalities of enforcing it, and of course, which sectors would be hit hardest? You're talking about maybe hospitality, manufacturing, food production, the farming sector. Those are some of the areas that probably would be on the front line of such a move. As you mentioned, Vice President Harris talking about a stricter policy, but nothing on the level of former President Trump is talking about. Again, another key economic policy where there's a significant gulf between both candidates.
And this is where I would encourage everybody to go read Adam Posen and the Peterson Institute's research on the deportation and the risks for inflation on steroids. And it depends what he can achieve under executive order as opposed to perhaps with a sweep. Enda, thank you so much. Enda Karen there in Washington. And you can find all your upcoming election information, news flow on the terminal. It's ELEC Go. We got it there for you. The polls are live every day. We're counting down to the jobs report. We have a little bit of Fed speak to sprinkle around as well. Mike is off to speak to Goolsbee. We'll give you the rundown in just a moment. From New York, good morning. There is only one event globally, 8:30 a.m., the jobs report. Tune into Bloomberg for that. We will then have Fed Speak galore for you, which is New York Fed President John Williams at 9 a.m. Mike McKee sits down with Fed President for Chicago, Austin Goolsbee, at 10 a.m. Want to get a few stocks in for you. Zim, integrated shipping, U.S. dock workers, they've halted the 3-day strike. The stock is nicely bid this morning. Spirit Airlines, keep an eye on that. There's Spirit Airlines down 41%. Efforts to avoid bankruptcy have hit a snag after months of talks. Bondholders failed to deliver a deal. Summit Therapeutics, drug maker, says the FDA has granted fast track designation for the use of its cancer drug. Good morning from New York on Jobs Day.